We had phase one of the bear market, which was a 20% decline in the S&P 500. The predicate there was, hey, we're heading into 2022. We have record high inflation, and there's keen anticipation of a Fed that's going to be very, very hawkish, on top of the most expensive stock market we've ever seen in history. So we had that decline. That was phase one. That lasted from basically early January all the way to the end of June. Phase two, which I believe is going to start very shortly here, it might have already started, but for sure, in my opinion, will start late September or October, is going to be an intense earnings and economic recession. And the predicate for that is going to be the bursting of the three biggest asset bubbles that existed concurrently in history: equity prices, bond prices, and of course, real estate. The recession is going to be so intense, in my opinion, that even Powell, Yellen, and Joe Biden will not be able to deny its existence.
Or change its definition.
Or change its definition. You know, people want to change, oh, it's, is it a bear market? Is it a recession? That's not the point. The point is, if for an investor, is to identify the rate of change of the rate of change, the second derivative of growth and inflation. And if growth and inflation are going to plunge precipitously, you have to make that move proactively in the portfolio. So did you do it or did you not do it? We have a model here. It's called the inflation, deflation, and economic cycle model. It identified the fact that the second derivative of growth, particularly, and even inflation, we are in a disinflationary environment now. It should morph into deflation if the Fed prosecutes on their plan, and we'll get into that later. So if you have a plunge in the rate of change of growth, you have to make changes to your allocation. We did so in late December, and we are getting ready to make another change heading into the second half of this year, as we're in the second half, or towards the fall and winter, when I expect the recession to grow particularly salient.
Okay, I want to dig into all of that with you. Let's start first with, you mentioned that you have a model. It was telling you to batten down the hatches coming into this year. How has that model performed so far in this year, where the markets were down anywhere from 20% to more, and they've recovered a little bit, but they're still down double digits? How's your model done?
So, I hate to quote a lot of returns here because the SEC always tells you, hey, if you quote one return, you got to quote all, or you can come to me and ask me or my staff anytime. I'll give you all of the returns for the entire existence of the model. But you asked me a specific question, we're down a little more than 1% so far in 2022. The primary reason for that, even though we have a net short position for our customers, is that the bond portion of the portfolio did not perform well. So you think about July. Why did July provide us with a bear market bounce? For many reasons why a bear market can bounce, and people come up with all kinds of excuses for one. But the primary reason was because Powell pivoted due to the fact that inflation peaked. Well, let's see if that happens. We don't get the inflation print till tomorrow. But if inflation peaked, it's peaking from 9.1% down to 8%. It's not going from 9% anywhere close to 2%. So we have ostensibly a Powell pivot, which is going to cause the stock market to rise. That hasn't happened yet, but people are hoping that the peak in bond yields will literally yield higher returns in the stock market. But no, concomitant with lower bond yields is going to be a salient recession, which is going to bring earnings down. So peaking bond yields and peak inflation is going to equate with lower stock prices, just like it's done every other recession in history.
If you enjoyed this video clip, click here to watch another one you should like.